Welcome to AI Explains ICT. We're kicking off core content for month 10 with episode 1. Now, you're definitely going to want to grab a notebook for this because this month we're really expanding our horizons. We're moving beyond Forex and diving into commodities, bonds, and equities. So here's the game plan for today. We're going to break down a really powerful, professional way to look at the market. It's all about understanding what the biggest players are actually doing, not just what it looks like on the surface. All right, so first things first, we need to get familiar with our main tool here, the Commitment of Traders Report, or as everyone calls it, the COT report. So what is it, really? Well, it's a report that comes out every single week from the Commodity Futures Trading Commission. Think of it as a peek behind the curtain. It shows us who's holding long positions and who's holding short positions in the futures market. Okay, so this is the chart that most people see when they look up COT data. Up top, you've got your standard price chart. This one happens to be the Japanese yen. And then down below, you see these squiggly lines bouncing around. These lines represent the positions of the big players in the market. Now, the report splits everyone into 3 main groups. You have large speculators in green, small speculators, that's basically the retail crowd, in blue, and then you have the commercials in red. Now listen closely because this is important. For our analysis, we are going to completely 100% ignore the green and blue lines. Our entire world revolves around that red line, the commercials. That's the smart money. All right, let's dig into why this is so critical. Because there's a huge fundamental misunderstanding about this report that sends most traders down a completely wrong and often very expensive path. You know, the typical logic seems to make perfect sense. If the commercials, the smart money, are super net short, well, that must mean they're selling. And if they're selling, the price has to go down, right? It seems so obvious. But then you see a chart like this. This is the Japanese yen back in 2016. For months and months, the price just screamed higher in a massive rally. So where were the commercials? Well, if you look at that red area at the bottom, they were holding a gigantic net short position the entire time. This is the exact paradox that makes people throw their hands up and say, see, this COT stuff is useless. But here's the secret. They're not wrong about the data, they're just reading it wrong. That simple view, net short means down, net long means up, it completely misses the real story that's hidden in plain sight. To get to that real story, we have to look way beyond just that simple net position. The key, according to ICT, is to learn how to separate the commercial's long-term game plan from their short-term tactical moves. You see, you gotta think of the commercials as operating on 2 different levels. They have their long-term program, that's their overall bias, kind of indicated by whether they're above or below that zero line. But the real magic, the real actionable intelligence, is hidden inside their short-term hedging programs. And this analogy just explains it perfectly. These commercials aren't just speculators placing bets. Think of a company like Hershey's. They need cocoa, and lots of it. If their analysts think cocoa prices are about to go up, they will use the futures market to buy aggressively right now, locking in today's lower price. That's not a speculative bet. It's a proactive business decision to manage their costs. So the big question is, how do we actually see these hedging programs on our charts? Well, lucky for us, ICT lays out a very clear method for doing exactly that. The very first step is simple. We get rid of all the noise. The chart on the left is what everybody else is looking at with all those confusing lines. We don't care about that. The chart on the right, that's our new reality. We've isolated just the red line. That is our entire focus. Okay, so the process is really straightforward. Once you have that red line all by itself, you look back over the last 6 or maybe 12 months, find its highest point and its lowest point. That creates a kind of normal range for its activity. What we are hunting for are moments when that line makes a sudden, aggressive move to the very top or the very bottom of that specific range. ICT calls these extremes nodules, and they are our signal that some serious hedging is going on. And this chart just brings it all home. We're back to that 2016 yen chart, the one that stumps everyone. So yeah, they were net short the whole time. But look closer at these moments highlighted by the green circles. These are the nodules. These are the times when the commercial's position hit an extreme low relative to its own recent activity. And what happened immediately after each and every one of those aggressive buying hedges? Price rallied hard. Now, this kind of analysis is incredibly powerful all on its own, but it gets even better when we plug it into a complete trading framework. You don't want to use this in a vacuum. Your highest probability ideas will come when you can blend three things together. Number one, the long-term commercial program. Are they generally in a buy or sell mode? Number two, the hedging program. Are they making one of those aggressive moves we just talked about? And finally, number three, institutional order flow. Does the price action itself agree? Is price reacting to a key discount or premium level?
See, what we're really hunting for is confluence. When the long-term bias, the short-term hedging signal, and the story that price is telling us all line up and point in the same direction, well, that's when you can have the highest level of confidence in your idea.
So when you put all this together, you gain a massive analytical edge. You're learning to see the market in a way that is practically invisible to the vast majority of other participants. This slide just sums it up perfectly. The retail view asks a simple black and white question and gets a confusing, contradictory answer. The ICT view asks a smarter, more nuanced question and gets a clear signal in return. You stop seeing contradictions and start seeing the hidden footprints of institutional accumulation and distribution. You stop following the herd and you start tracking the smart money. It's like ICT always says, they can't hide their activity. It's all right there in the data. And now that you know how to read it properly, they can't hide it from you either. I really hope this gives you a powerful new tool to add to your trading arsenal. If you found this valuable, please do me a quick favor and hit that like button. It really helps the channel out. Make sure you subscribe so you don't miss our future deep dives. And of course, if you have any questions, just leave them in the comment section below. A real human will get back to you. Thanks so much for watching. Until next time, good luck and safe trading.